I would like to officially pass the stage and the time to our moderator, the Honourable Mrs. Cha. Over to you, please.
Thank you. First of all, good morning, everyone, and welcome to this very important forum, which is hosted by the Hong Kong Insurance Authority. I'm honored to be moderating today's first session. And as the MC has indicated, we're going to have a polling. And I don't know whether you already have time to vote. If so, can we have maybe 20 more seconds? And then we will have the polling results. But while we are doing that, let me introduce our speakers on the panel. First, we have Jad, who is the Managing Director of the Geneva Association. Before that, he has an illustrious career at AXA for 24 years. And before that, he started his career as a consultant at McKinsey & Company. And then we have Andrew MAIS, who is Connecticut's 33rd Insurance Commissioner. He currently is the President of the 2024 National Association of Insurance Commissioners. And he has a distinguished career in public service, and we're very, very lucky to have him today. And then we have Jeferino, who is the Chief Actuary of the Bermuda Monetary Authority. And he too, prior to joining the Bermuda Monetary Authority, he has been engaged in the actuary and insurance career and industry. And last but not least, we have Suzanne SMITH joining us virtually today. She is an executive board member of the Australian Prudential Regulation Authority. And prior to joining the APRA, Suzanne's career included a senior role across superannuation and financial services industry, and in areas including life insurance, funds management, asset servicing, and wholesale banking and property. So you can see that we have a panel of heavyweights in the industry, and we will start by having our panel members sharing with us their views on the polling result. So can we have the polling result, please? So I think, the theme that we are considering and being voted on artificial intelligence, climate risk, financial stability, geopolitical risk, cyber risk, and the increasing role of private equity fund. I think these themes not only reflect the insurance industry's concern, but generally across the board on many of the panels today in the financial sector, we addressed similar themes. So we can see that these themes are pretty evenly distributed, with geopolitical risk having 24%, and then artificial intelligence, 17%, climate risk, 19%, and financial stability, 18%, and cyber risk, 18%. And increasing role of private equity fund in industry is 3%. So with that result, can I invite each of the panel members to share with us their view on the poll result, and what is your particular, in terms of your area, in terms of your jurisdiction, do you think that these reflect what you have in mind also?
Thank you very much, Laura. I am going to comment on these results, but let me first thank the Hong Kong Insurance Authority for hosting this event and for inviting me. Thank you very much, Clement. It's a pleasure to be in Hong Kong. Last time I was in Hong Kong was 30 years ago, back to my McKinsey years.
Oh my goodness.
So it's really a pleasure. Coming now to the results of the poll, I am not surprised by these results. If I had to choose the top three, I would have certainly chosen geopolitical risk. I would I would change slightly the word geo-economic, and I will explain this in a minute why. I would choose, obviously, climate risk and cyber risk. And what these three themes have in common is that they challenge one of the basic principles of insurance, which is diversification. When insurers underwrite climate risk, they do not expect that there will be, in the same year, floods in the Asia-Pacific region and in Europe and in North America.
Right.
And they do not expect that there will be wildfires in the same year in the Asian Pacific region, in Europe, and in the Americas. And so this is really challenging because it's getting much more difficult to diversify your risks if you're a global insurer, and the same holds true within the same region. And the same holds for cyber risk. One of the characteristics of cyber risk is that a major cyber event will, in all likelihood, impact all sectors of the economy and all countries, regions worldwide at the same time. So we understand the challenge for insurers who underwrite cyber risks to manage their exposure. And finally, geopolitical or geo-economic risk. The reason why I prefer geo-economic to geopolitical is that the tensions have started, I would say, before geopolitical tensions, and I will refer to the pandemic as the starting point. During the pandemic, countries have started to realize that they were overly relying on offshore supply chains. And so since then, they have started to reprioritize strategic autonomy, to reprioritize their own independence, to reshore activities, and that is fundamentally changing the insurable risk landscape. So this is as an introduction, my perspective on those three risks. Thank you, Laura.
Thank you, Jad. Can I turn to Jeferino? And what about your views on the polling results?
First of all, thank you so much for inviting me to be a member of this panel, and I'm very happy to be back in Hong Kong, where I actually was born originally in Hong Kong, so I'm a Hong Kong.
Yeah.
Thank you. In regards to the risks that the members, the poll actually voted for us, yes, from the perspective of Bermuda Monetary Authority. They are actually very similar to what have been voted by the poll. First, with the geopolitical risk, from our point of view, it is very important to, in the insurance industry, it is very important to allow companies to diversify. And having open borders to allow the capital flow and capacity to cover global risks, which includes climate risk and financial stability. And this is very important for us. So another topic that is very important for us is really resilience. So in the BMA, what we've introduced is several supervisory and regulatory changes, so we can enhance the financial stability and resilience of our industry, facing the new challenges, the changing in the life sector reinsurance. So this is something that we've done. And climate risk is also very important for us. First, because Bermuda is a tiny little island in the middle of the Atlantic. So climate risk is very important for us in terms of the existential existence, but also for us in all this, also with geopolitical and financial stability, the background of all this is the is the protection gap. So we have to ensure that there's enough capital can flow, and also the risk can be diversified across the globe. So this is very important for us in the BMA.
Good. Thank you. Thank you. What about you, Suzanne? What is your perspective on the polling results?
Thank you. And firstly, thank you for having me. Thanks very much to Clement for the invitation. And I'm sorry I'm not there in person to join you on stage. I think similar to the other speakers so far, we certainly agree that these are the big issues. Geopolitical risk is a strong focus for us here at APRA, to the extent that we're introducing some new cross-system stress testing that's really starting to look at the intersection of that risk across the different areas of our banking, insurance and pension sectors. But really the 5 focused areas for us from an insurance perspective perspective. Number one is climate change. The impact of extreme weather in Australia has more than tripled over the last 3 decades. Extreme weather losses are now consuming more and more of our economic resources. Now, insured losses have grown from 0.2% of GDP now to, from the last 5 years, from 95 to 2000 to up to 0.7 over the most recent 5 years. And interestingly, over the last 30 years, Australia's paid an average of $2.1 billion per year to customers, and that's more than doubled over the last 5 years. So it's really significant. We'll talk more about climate a bit later, I think. Second for us is cyber and AI. I think IT outages and malicious cyber attacks are just ever increasing, and data breaches for us have been a really big issue where we have had some exfiltration of data, particularly health data for us, and that's a huge issue, and they can have devastating impacts on the real lives of customers with the information that's being stolen. Rapid growth of AI, whilst it's great to assist with that processing and simplification, also understanding the governance issues associated with AI is absolutely critical. And actually the responsibility around data. And the key questions that insurers need to ask is, do you really understand that the data you're holding, do you know where it is? Do you know why you need to hold it? And should you be keeping it? The propensity just to continue to hold data forever and not cleansing and purging when the use is finished is central. Similarly, household protection gap is a huge issue in this country. We've seen with the devastating number of natural catastrophes, just significant rises in premiums, and to the extent that the Actuaries Institute have had some recent statistics that say that 15% of households really can no longer afford insurance premiums. And probably finally, the other issue that we're focusing on is outsourced underwriting. I think the operational resilience is key, and this look through to actually really understand how your service providers are operating within your ecosystem is fundamental for the resilience of insurers. Thank you.
Thank you. Thank you. Last, Andy, what about the priorities in your jurisdiction?
Thank you again for inviting me. It's great to be here back in Hong Kong. From my McKinsey friend, I will tell you the last time I was here on business, I was with Deloitte, the better consultant. And actually, since then, I've been here on vacation with my wife, and it was wonderful to come back. Thank you, Clement. I'm looking at that list, and what I'm going to go through shortly is a list that we, as U.S. state insurance regulators working together through the NAIC, created for this year as our priorities. But one that's not on there that perhaps would be now is geopolitical risk. And I will tell you almost 2 weeks ago when I left the U.S., the Middle East was a very different place. We have seen so many changes over the past year. We have seen so many dramatic changes, and we can only expect more. And that kind of uncertainty, I will tell you, to me as an insurance regulator is scary. One thing we all want is some kind of certainty. And for us, the thing that we have to do is to ensure that there is solvency, that companies and thus consumers are protected no matter what may develop and where. And that's why I'm going to just take a minute out to say that's part of why the insurance capital standard is so important. I had the honor of being the one to introduce the resolution at the IAIS meeting in Cape Town a few days ago that was accepted. And again, I have to thank Clement and the Insurance Authority here for their central role in getting this through. And I know I'm taking up time, but I do want to let you know we need a global standard so that we can assess the strength of insurance companies. Insurance is a business of trust. And what made that difficult? It's taken probably 13 years to get here. We've got very different systems, and we don't always speak to each other well. And I will tell you, having somebody respected who was willing and able to step in and do more than translate, but guide the way was of tremendous value to us. And I do want to thank Clement. I mean, you were central to us having an insurance capital standard, and I look forward to working with you as it's implemented. Now, to go to the issues that we at the NAIC, the 56 insurance jurisdictions in the United States identified at the start of the year, and I'm hoping that this mic is working. Climate risk and resiliency. We all know the reason for that. That's clearly an issue of concern, and we have seen that the way that the climate scientists will tell you we need to respond. Mitigation, adaptation, migration. We have to begin with mitigation, clearly, and adaptation. That's where we are in the U.S. Otherwise, what we will end up doing is we will create a system, as unfortunately in some places we've seen now, where the insurance, where the safety that insurance provides is no longer available or affordable to many. So this is an issue that we need to address. Ensure financial oversight and transparency, and that's probably be related to both private equity funding and financial stability. The structure of certainly the life insurance industry has changed. We need to make sure we understand it. We need to make sure, again, our North Star in the U.S., that consumers are protected. Marketing of insurance products, same thing. We want to make sure insurers are protected. Race and insurance in the U.S., we do have divergences that we need to address. We need to make sure that underserved populations are served. We need financial inclusion. We need to close that protection gap. And that's one reason that we have encouraged the use of AI. We know that AI is a tool that can be used for good or for ill. For us, we think it offers great advantages, but there have to be guardrails. And in the United States, we've developed those. We've got a principles-based system that says to companies, this is how we expect you to treat consumers. Now, within those principles, within that ethical treatment, feel free to experiment. Feel free to lower, hopefully, the cost of providing the most relevant products and services to the consumers we are all sworn to serve. So those are the top issues. I'm not sure I'd call them risks, but those are the top issues that we are focused on in the U.S. this year. They may change. We reevaluate this every year. It may change slightly. But frankly, I don't see it changing that much. These are long-term issues that both in the U.S. and internationally we will continue to address.
Thank you. Thank you, Andy. If I could ask a follow-up question. Now, although from the poll, the increasing role of private equity got only 3% response. But on that, can I follow up with you, Andy? How do you see the increasing role of private equity? How does that affect the supervisory concern for you as an industry, or for you as as a regulator in the industry?
Well, first of all, let me differentiate between ownership and activity. Private equity funds, like everybody else, have the right to own insurance companies. The question is, how do they do it? For us, what we have sought to focus on as we move forward is the activities that these funds and that all insurers go into. This is, again, going back to the idea that the life insurance industry has changed structurally. Over the recent past, we have seen an extended period of low interest rates. For us in the U.S., what that has meant is that for life insurance companies in particular, access to capital through the public markets has been certainly not as robust as we would have liked. Partly as a result of that, partly as a result of the need for capital to drive capacity, we've seen insurers move into more alternative investments. What does that mean? For private equity firms have largely been able to manage these investments, to originate and manage these investments profitably. You know, the investments have particular concerns. There may be liquidity concerns. You know, on the other hand, if you're chasing alpha in the period through which we just went, that was one way to get it. So in a sense, it was a marriage made in heaven. We had, and you know, our friends in Bermuda can tell you that because they were a center for this and they've done a tremendous job in managing it. We had private equity firms. We had private equity firms bringing new expertise to the market, which meant bringing new capital to the market, which meant bringing new capacity to the market that was sorely needed. Now, for us as regulators in the U.S., that did raise concerns. And a number of concerns. One is going back to the start when the private equity firms were just coming in. Did they really understand how heavily regulated this market was? Did they really understand that we were not looking for companies to pop into the market today and leave the market tomorrow? That this was not about a short-term profit. It was about a long-term investment in the insurance companies because that is necessary for the trust of consumers. There were other issues. Again, the liquidity issue, transparency. If you've ever looked at some of the org charts of some PE firms and their affiliated entities, that may not have been the easiest to decipher. We wanted to make sure that there were no related transactions that were improperly priced. There was all this information that we needed. And we have certainly spent a significant amount of time, put a significant amount of effort into making sure that we have the necessary transparency and oversight. And it's not over yet. You know, just recently this year, for instance, our Securities Valuation Office is now looking at rating agencies. One of the things that we've seen with these private placements is that the ratings can vary tremendously depending on who does it on a single security. We need to make sure, we need to move in a certain sense from a blind reliance on rating agencies to informed reliance. We need to make sure, for the sake of us as regulators, for the sake of our consumers, for the sake of solvency, that investments are properly burdened, and that means that they're being properly assessed. So there, you know, we've got on there, if you just go to the NAIC.org website, we've got a list of 13 items that we've been doing. I know my time is running out, but I would suggest you take a look on it. There are a number of issues that we're working on, and we continue to work cooperatively, both across the states and the U.S. and with our counterparts across national boundaries.
Thank you, Andy, for a very thorough explanation of the role that private equity has played or continue to play in the industry. Now, if I could turn to Suzanne. Suzanne, you have already mentioned the increased frequency and severity of natural disasters, climate-related events. Now, how should insurance company manage this risk, and what are the supervisory expectations?
Great, thank you. So in Australia, we issued Prudential guidance back in 2021, which really guides all of the entities, our regulated population across banks, insurers and pension funds around what we set as their expectations of managing climate, understanding the risks and opportunity, ensuring underwriting decisions are well informed, and ensuring that you have appropriate risk governance and scenarios around those to really know how you're handling that. We recently undertook a climate self-assessment study which actually looked at how the entities are managing against those that Prudential guidance from 2022 up until now. And it was interesting to see that most entities have actually improved their maturity in relation to climate risk, which is good, although we've seen a quarter of our entities actually go backwards, which is very interesting in itself. And largely, our insurers hadn't made much progress from 2022 until now. Saying that, the areas of strength were governance and strategy as well as risk management. Disclosure were the areas of weakness. But we did find that those more mature governance structures do have climate risk embedded into their risk management, and I think that's a really important element. We're also working on a climate vulnerability assessment here in Australia, where we've asked the 5 largest insurers in our country, representing 80% of the households, to undertake an exercise to start to look at where climate risk will continue to emerge in the future and what that may mean for insurance affordability and availability. So we have two scenarios based on the Network for Greening the Financial System, the NGFS, which has different emissions reductions pathways just to see where the risks may emerge. And we're hoping that that will help inform some of the mitigation activities that need to happen in this country, not just work by insurers, but importantly by government. And one of the key things for us is also to help upskill our supervisors to really understand how to engage with insurers on climate risk and look at what the opportunities are, particularly around strengthening risk management and governance. What we do know is that insurance policies exposed to climate risk are typically repriced every 12 months, which does allow for rapid adjustment by insurers of premiums to account for that underlying risk. But what the risk of that is that significant price hikes result, which put shocks back to the community in terms of their ability to meet those new premiums. And the reality is that a successful insurance industry isn't about stable insurers in covering a small proportion of the population. I think that's where Andy talked about there are many underserved consumers right across the world, and our focus is on trying to create or sustain a thriving insurance industry that allows people to lead their best lives because they have that access to insurance cover. And so importantly, we're encouraging transparency of insurers. How do we really get transparent around what consumers can do to reduce their premiums, what role insurers can play, and how we can work together to keep premiums down to ensure that availability and affordability is sustained. Thank you.
Yeah. Thank you. Suzanne, I think you hit on a very important aspect from a consumer's point of view. When we talk about various insurance or the need for insurance to cover various kinds of risks, affordability and availability are always on the top of the concern. While the industry could provide different policies to cover different aspects of the risks that we are facing these days, increasingly the premium that the consumer have to pay is also a consideration. And I think that will, as we face more and more climate risks and geopolitical, geoeconomic risks, I think the availability and affordability has to be part of the equation as well. If I could turn now to Jeferino, as shared by the other panelists, I think the industry is facing a changing and very challenging landscape. What are the key elements to maintain financial stability in the view of all these risks that we talked about? And then how can the regulators have an early detection of a systemic risk? Over to you.
Thank you. I echo many of the concerns raised by Andrew. And actually, in the Bermuda market, we observed a massive increase of the life sector in our market. So what we started to do is we had to increase the number of staff with the appropriate expertise. So the staffing on the life sector increased. I mean, the staff in the BMA increased by maybe 30% or more in the last few years. And also we hired many of the people with expertise. So the actuaries that we have right now is maybe 10% of the total staff, which is quite high compared to other regulators. And we hired also people with expertise in asset management and also structured assets. So this is the people that we needed to hired to face this new challenge that we encounter, but we also introduced some changes in our regulation. So we introduced some changes in order to clarify the disclosure and also in terms of the regulatory expectations. So those are were summarized in several consultation papers, and then they are then introduced into the rules. But also the entire framework of how we supervise the companies also change. So, for instance, now we engage much more with other regulators. When we see a transaction, we engage with other regulators. We engage with the other members of the Supervisory College. We engage much more with the companies, making sure that the functions are in place. There's no, they have the actual expertise, and there's absence of conflict of interest. The type of assets are also different, so we make sure that the assets are in line with the liabilities and they are adequate. So we introduced the prudent person principle in our legislation. And for some PE-backed reinsurers, we introduced the recovery and resolution planning. And I think, but for the early detection is really that all the transactions, the block transactions, are pre-approved by the BMA. So by approving the transactions previously, what we've done, this will allow us to engage with the cedents regulator, understanding the valuation and regulatory framework of the original portfolio. This allows us also to make sure that the control functions and the asset management expertise are in the company, understanding the impact of liquidity, and this will, when we pre-approve a transaction, we ask for some stress tests. We try to understand the type of assets. So everything is much more in a lower level conversation in which we drill down into very specific and detailed analysis of the underlying assets, just to make sure that we understand the structure and also detect any emerging risks. So this is what we've been doing. But this is a market in which the transactions are only possible if there is trust. So we see that there's a lot of comments and also from other regulators, because sometimes it took us some time to understand the structure, and the assets that are backing them. So what we've done, the BMA has done, is to share some of our experience. So we published a paper in which we shared our experience, regulatory experience, and we shared with other regulators how this new type of PE-backed reinsurers can be supervised and how regulators can gain comfort. We also shared some information on from our market, and this summer we issued 3 reports in which we analyzed the liquidity of these companies, the liquidity, how the structure of the collaterals, and also private credit. So we issued a series of 3 papers. They are in our webpage, and I invite you to also have a look, so you have a better understanding, a more comprehensive understanding of this new trend in the life sector.
Thank you, Jeferino. Now AI, I think in any kind of forum in this year and recently, whatever the topic of the forum, AI is necessarily a key element of the discussion. And Jad, can I turn to you and ask you to share your view on how AI is transforming the insurance industry, and what are the effective way to manage the risks that will be posed by AI in your industry?
Sure, Laura. Let me first share with you an experience that I've had in my current role at the Geneva Association. When I took my role 6 years ago and we would start having these conversations about AI with our members, the CEOs of insurance companies, there were 3 clusters. There was a first cluster that would say, CEOs would say, you know, for me, AI is not tomorrow. It's already now and here. It is already transforming my business. And I'll elaborate on this in a minute. There was a second cluster, which was, I'm starting this journey. We are doing use cases. I'm not convinced yet, but we are starting to experiment AI in a number of areas within the company. And then there was a third cluster, which I would call the skepticals, who were thinking, well, maybe AI is like blockchain. You know, remember 10 years ago, everyone was talking about how blockchain was going to revolutionize the insurance industry, and that really didn't happen. And now you have much less people who talk about blockchain. And so we have the skeptical. 6 years down the road, cluster number 3 doesn't exist anymore. Everyone has moved up the ladder, I would say. Cluster number 3 has moved to cluster number 2, and cluster number 2 probably to cluster number 1. So there isn't a single part of the value chain of insurance that is not impacted by AI. And I would say there are 3 major areas of the value chain. One is marketing and distribution, being much more relevant in the marketing efforts and in supporting the distribution networks and the offers they make, bringing more relevant products to the customers at the time where they most need it. Number 2, underwriting, risk assessment and pricing. And number 3, claims, especially using AI to detect fraud. So all the elements of the value chain are being transformed by AI. As Andrew was saying earlier, AI, it's a tool. It's not a risk. It's a tool that can be used for good and for ill. And so it's very important to also be aware, as you run an insurance company, of the risks that AI entails. I would say there are essentially 2. They're not new for the industry, but they are particularly acute in the context of AI. One is transparency and explainability. We've all seen this situation where a customer goes to this agent and says, well, my insurance premium is going up 10%. Can you explain to me why? And then the guy says, well, actually, I don't really know. But don't worry, I'll ask to someone at headquarters and they'll tell me. And so they call someone at headquarters and the guy says, well, actually, the machine says so. So it must be true. Well, this is the situation we want to avoid. And so explainability, transparency is very important. And number 2, fairness. There has been plenty of literature in the past 10 to 15 years about unconscious biases at the human level. Well, AI really reproduces human behaviors. And so it's very important to be aware that there may be in AI some biases, and so that the companies have to identify it and correct this. And so what are insurance companies doing to address these risks? They're essentially doing 3 things. 1, equip themselves with a set of principles along the line that Andrew was referring to earlier. And most, if not all, insurance companies have now developed these set of principles that they share with their customers, with their distribution networks, to say, this is how we're using AI, this is the things we're doing, these are the things we are not doing, and this is the governance. So number 2, 1, set of principles. Number 2, governance. Some insurance companies have hired on their board of directors 1 or 2 AI specialists to support them. Other companies have equipped themselves with a panel, an external stakeholder panel with academics in the AI sector, representatives also from consumer organizations to support their efforts in AI. And number 3, third initiative, very important, is training, investing heavily on training the staff, the people on AI. Not only the people who work in AI, but also the people who are front end on the field to tell them, this is how we are using AI. And this has another benefit also, is that, as I'm sure many in the room are aware of, AI is also a concern for employees themselves. Will my job be there in 5 years or 10 years down the road? Well, training them, explaining to them, educating them will also address this concern.
Yeah. Thank you. I think, Jad, you have said it very well. I think AI is both a challenge, a tool, and also an accelerator of what we can do or what we are doing. It is here already, and it is up to us how to manage and how to utilize and how to leverage what AI can offer. Now, one final remark, we only have 1 minute left, and I would just open this to the panelists, to perhaps anyone would want to share your view about how the different jurisdictions can collaborate in the face of all these challenges. Andy?
Well, clearly through the IAIS as one forum, through the multinational forums at the NAIC, and certainly on the state level, we're members both of organizations like the OECD, SIF, for instance. But I'm sitting here next to my friend from Bermuda, and I will tell you, I've been to Bermuda, 3-4 times this year, and they've been over. There is that ongoing discussion, as he mentioned, the idea that if something comes up, you can pick up the phone and talk to somebody. Same thing with Clement. You've got what we need is that ongoing cooperation so we can see risks before they emerge. And if anything happens, we can address it.
Yes. And this is not only just physical visit, because we pick up, I think, with other commissioners, we speak almost on a weekly basis. So there's enormous exchange of information and monitoring on of the new transactions, a lot of cooperation.
Thank you. Jad?
Yes, I will add that the problems we are all facing, the challenges we are all facing are becoming increasingly complex. And so no one alone has the answer. And so I think platforms like this one, the Asian Insurance Forum, which brings together regulators, supervisors, representatives of the industry, think tanks, are very fruitful because we need to develop the solutions together rather than one party.
Yeah, thank you. Suzanne? You have the last word.
Yeah, just one thing to add. Insurers can't do this alone, so it has to be a mechanism that involves government, regulators and insurers. In Australia, the government set up what's called the Hazard Insurance Partnership, which is actually bringing the regulators, the government and the insurers to the same table to actually look at mitigation steps to put in place to really try and have an impact on how we deal to the ongoing issues of climate. So I agree with everything that everyone said. It just has to be about sharing knowledge, working together and global coordination. Thank you.
Thank you. I think we have had a very fruitful discussion in the last 40-some minutes, and I hope that you guys have a lot of takeaway. And I want to thank our panelists, distinguished panelists. Please join me in thanking all of them.
Thank you.